Today's guest is somebody who I've been trying to connect with for a while, and I've watched him from afar and really been extremely interested in some of the posts and the content that he's been putting out. And when you find out who this person is, you will understand why I have felt that way and why I feel very honored actually to have him as a guest on my podcast today. So, my guest today has been involved in wealth management for boutique investment firms in Switzerland, and also as one of the UK's top 10 lenders. Well, he was a cross business consultant for one of the UK's top 10 business lenders. He was the Dean Scholar at Warwick Business School in the MBA class of 2013. That is very impressive. And since 2011, he's been involved in lots and lots of property transactions, 650 at the final count, but probably there's more to add to that. We'll find out today. He's purchased flats from as little as £23,000 right up to buying portfolios of 91 properties at a time. And he's done everything in between. His goal has always been to add value, to buy at a good price, add value, and then refinance and hold. Now, there's been some development and selling along the way, but 90% of it, the aim has been to retain those assets for income. Adam, I've given his name away now. He has shares in a number of trading business interests focused around property and the support services that we all need, of course, if we're investing in property on a day-to-day basis. He's privileged to work with people who he considers to be amongst the top letting agents in the country. And within his group, he's built it around a joint venture model. With a huge amount under asset management, which is very, very impressive, with a loan to value under 60%. So today, I'm delighted to invite Adam Lawrence to be here as my guest. Welcome to the HMO Success Podcast. I'm your host, Wendy Whittaker-Large, and I'm here to help you create a profitable HMO portfolio. Whether you're a brand new investor or you've been at it for a number of years, my podcast is here to help you make the most from your business, whether that is starting up, scaling, or systemizing. Please hit the subscribe button to make sure you never miss an episode. And if you've got an awe-inspiring project, an inspirational investing story, or a unique approach to HMOs, I'd love to hear from you. As you know, I love to start the podcast with a round of quickfire questions. So Adam, your challenge today, I'm going to ask you 5 quickfire questions, and the rules are these. You either have to answer yes or no, or give a very short answer. Anything longer than that, and I will edit you. I'll use my editorial rights to edit the answer out. So it's either yes or no, or a very quick answer. Do you think that's achievable?
I'll try.
Right. Okay. So some of these are questions that I've been asked. Some of these questions have come in from podcast listeners, and some of these are my own creation. So let me start with question number 1. When you're investing in property, are interest rates something to worry about?
Yes.
Thank you. Okay. Number 2, should you hedge in some way when you invest in property?
Yes.
Number 3, do you think it's important to use other people's money when you're investing in property?
Important. Yes.
Great. Love it. Okay, great. In terms of what is most important to you, capital growth, cash flow, or long-term time in the market?
Cash flow.
What would you say is one of the most important personal development skills you need to develop when you're investing in property?
Relationship building.
And finally, can you give us one of your top tips for investing in 2024?
Be creative and look for the solutions that other people haven't considered.
Amazing. 10 out of 10, 5 out of 5. That was great. Thanks, Adam.
Brilliant. Thanks, Wendy.
Welcome,
thank you
Adam.
so much, Wendy. That's the most wonderful intro I've ever had anywhere. So thank you so much for that.
Well, it's very impressive, your background. And Adam, one of the things that first kind of brought me into your sort of orbit, as you could say, is when you started talking about things macro, financial systems, financial positioning, macroeconomics, because I'm really interested in that as well. And I've always felt that if you don't really have an understanding of macro, you're not going to understand where property fits in. And when people talk about property cycles and so on, which I have a little bit of question mark in my mind about, if I'm really honest about it, because I think that property cycles are really just a product of wider economic situations. And we might call them cycles, but actually we have to sometimes look a bit bigger. But I know that's something you're very interested in as well, isn't it?
Absolutely, and I've got a few things to say on things like the 18-year property cycle if you want to. But I think what you've just said is absolutely spot on, Wendy. To be honest, yeah, wheels within larger wheels, absolutely right.
So tell me a little bit about why you got started in property, given you had kind of a financial services background and your background was very much working within the money financial sector.
Yeah, so I was actually just around out of there just before 2008. So I'm not saying it was my fault because I left, but it was very obvious to me that in the sort of embers of that, so we sort of wind on towards maybe 2010, that we still had too few houses in the country. The interest rate had obviously come down quite significantly. The rental market was actually doing very well because, as you know, lots of people held on to what they had and rented it out. And there was lots of need for rent because people couldn't get mortgages to buy anymore suddenly. So all of those people that were left with sort of legacy mortgages from the whenever they lent to anybody, whether you had a pulse or not, sort of days before 08, had what people needed, which was rental supply of stock. And then it appeared that the private rental sector was growing nicely. I didn't see a quick fix problem for how, the market obviously had corrected by then. So we got to see what had actually happened to prices and where they settled once the crazy credit days had kind of been withdrawn. And we got to see where they were when credit was very, very tight. And I thought, well, if credit's so tight, then this is probably prices are at a bit of a low at the moment and credit probably will return because markets tend to grow. The regulators, although they were quite slow, they were doing quite a good, robust, thorough job, as you'd expect in the wake of a massive crisis, and probably played too much Monopoly as a kid as well, Wendy, to be honest. So it all fit together perfectly. And I thought, no, could I build a sustainable cash flowing business? And that was my key starting point, because I simply as anything knew that 99% of businesses that go out of business are because of cash flow.
Yeah, absolutely. So that was a very wise decision, I think, early in the day. And particularly at that time, 2011, we're talking, as you say, there was still quite a lot of nervousness in the market, but money was being a bit more, it was slowly being relaxed in terms of how it was being lent. And as you say, there were some restrictions that were coming in. CML was bringing in a few more restrictions and so on. There were, more stringent loan to value ratios being required, etc., which was quite a big shock, I think, for those of us who'd been investing prior to 2008, where you could get 100% mortgage, and now you had to put down a 25% deposit. I think that for many people, that was the point where they thought, oh, that's it, I don't want to invest anymore because it requires too much of my own money. But of course, it seems that while that was the situation you were entering into, that therefore required you to have a mindset of being creative and adding value.
Yeah, I think
which sounds like that was exactly what you did.
Well, that's it. And I started out reading about people doing all money out deals and kind of getting around this problem in that way. And then when you first hear about it, you think, oh, buying things 25 or 30% below value, that's just fantasy. Nobody does that. Whereas in the real world, actually, we know that a very, very small percentage of people do that. But when you break that problem down into, can you buy really quite well and then add value really quite well? Then that 25% or whatever breaks down into two chunks of 12.5%. And suddenly it doesn't seem like such a big mountain to climb. And you can potentially find stock or improve stock in that way. And so that's 45 seconds of something that took me maybe 12 months to get my head around in that way before I could try and do that. And then then years and years after that of trying to connect with and study and work with people who were doing good deals in volume, because I knew there was a small, very, very small community doing this. I saw evidence of it on Companies House. I saw evidence of it, just anecdotal evidence of it, people talking to people and introducing me to people. And then I decided I needed, it didn't take me long to work out that deals was the scarce resource. So once I'd worked out the deals were the scarce resource, I then needed to work out how to do the deals.
Which is fascinating in itself, isn't it?
Oh, well, I probably spent 4 years where my main focus, like more than 50% of my time, was working out how to do better deals, who to connect with to connect me with people who are doing better deals, and just sort of through everything I thought I knew about property, like when we all started, probably we bought from estate agents, and then thought, right, how else can we buy property? Well, let's look at it systematically. Obviously, there are auctions, but then there's this world of property traders / cash buyers / wholesalers, whatever you want to call them, that also exists as a niche part of that marketplace. And so working with them, and then also looking at direct to vendor, which has been, talked about in very different ways over the years that I've been involved on the property circuit. All of these ways were ways to get property to come in. And then also, local authority disposals, local authority matchmaking. So there's so many when you go through it of brokers who don't know that they're brokers, if you like, sources, etc., etc. Organising all of that in my head and getting the strategy really set around that was something that kind of went on in the background as I was doing, as everybody does in the early days of trying to build a business, scrapping around, trying to get whatever I could, do as much as I could myself, writing that off as, that's all part of my education. So as an example, I went and did a 1-week intensive plastering course, and I'm not very good with trades, Wendy, if I'm honest with you. So that was, apart from doing a little bit of my brother's house afterwards and plastering the first refurb we ever did, I haven't picked up a hawk and trowel since then. But it taught me loads about plaster, but also about how projects work and how contractors work and the mentality and the organisation and the what's important beyond just what price is John charging per day to paint the wall. Okay, you can get bogged down in that stuff a little bit, but maybe Pete's 25 quid a day extra, but he turns up earlier and goes home later and has never missed a day of work in his life. Well, then we might want to consider Pete, mightn't we? But Pete doesn't get on well with Steve. Well, we might need to sack Steve and find somebody else. And just working all of that stuff out, I suppose, at a really granular level, which was good learning.
From what that's a very, very good story, very good example of understanding how people work. And from what you've said, one of the, while you may conceptualize it as being a system or being a process, which certainly it is, it seems to me the other thing that you very early recognized was the fact that property is a people business, and that you need to know the right people in those different niche sectors, whether it's plastering or whether it is somebody who's working on the empty homes council strategy, or whether it's somebody who is sourcing in a particular area of a particular town, or whether it is an insider in the auction world who's the first call for banks and financial institutions where there are repossessions. Wherever these key people sit, it seems that you've made it your business to go and find them so that you can be on their hit list or their call list when they get a deal through.
I think that's really insightful, Wendy. Yeah, I'd say that's absolutely what I think I probably realised as the days, weeks and months went on, how much more of a people business it was than I really thought, because I'm a maths geek, I'm a spreadsheet nerd, so the numbers made sense to me. They always made sense. They make sense today. They were probably tougher to make sense in 2023, but not to the point where you throw the baby out with the bathwater. But as I went along, I realised how much more and more and more people became more and more important to what I was doing rather than numbers. Yeah, absolutely right.
So tell me a bit about your that numbers side, because I'm really interested in that, and I think this is something that I know you're very passionate about as well. understanding the bigger picture, the economic whirlwinds that we exist within, not just in terms of, we could talk about interest rates and inflation and all those indicators that are critical, but there's other stuff that's going on beneath the surface as well. Can you tell us what are those things that, either keep you up awake at night, not because you're worried about them, but because you're interested in them, or get you up early in the morning because you want to learn more about them?
Well, I certainly started putting a lot more legwork into the macro and then sharing what I was doing because I hoped it would be of value to the broader community, which I felt had given me a lot over the years as I'd come up through it and gone to independent networking meetings and the likes. And then I would say in 2020, it would be fair to say that I was worried, Wendy, and I was worried because I was reading predictions from people and I was taking them seriously. And then I thought that something felt wrong. I thought I was already writing some bits and bobs on longer form content and putting it on social media, not with any massive sort of structure around it particularly. And I thought this just doesn't seem to be right. Every week I seem to be writing about things that people are getting wrong. And I didn't want to be that person who just criticizes everybody. There's no point criticizing everybody else if you're not going to provide a solution, right? So my solution was to say, right, can I? And I read a few bits and bobs on forecasting and things like that, especially one excellent book which is called Super Forecasting by a chap called Philip Tetlock, and he's got a co-author as well whose name escapes me right now, but it's a great book for nerds like me anyway, because it talks about people who have been able to become extraordinarily good forecasters of certain things and the methodology they've kind of followed, even if they haven't necessarily realized they've followed a methodology. Like a lot of the books that study success, it identifies the common threads in what they've all done. There's lots and lots of personal development books out there like that. And I thought, well, I'm not sure I can be one of these super forecasters, but I reckon I can definitely do better than some of these big institutions are doing. And also to, on one side, to kind of allay my own anxieties to an extent. I'm talking sort of COVID, pre-government stimulus, that sort of period before bounce back loans and all the rest of it. And I thought, right, I reckon I can have a go at this. And let's see if I share my findings, if people are interested. And as it's turned out, people have been interested. And I've always put them out there to kind of not necessarily provoke a response, but just to, start some intelligent conversation, connect with like-minded people, see if they want to push back on what I think is going to happen about inflation and interest rates and everything else. And if the macro environment's really difficult, I think the reason why one needs to be thinking about that is they need to think about, right, am I needing to be recapitalizing at the moment? Am I going to need to keep my powder dry? Now, 95% of the time, maybe even more, I would say you probably don't need to, and you don't need to overly worry about that. But if you feel you might be approaching a bit of a cliff edge, so to give you a sort of real life example of that, early 2022, I started to get uncomfortable with the pace of just how much house prices were going up, right? I'd already been talking about inflation for about a year and was wondering how the economy would cope with a higher interest rate. And I hadn't really formalized all my thoughts around that at the time. And then, of course, Russia and Ukraine, and my understanding of the macro economy, how much of our energy we import as a nation and all the rest of it. And we were already on an inflationary path. I thought, this could be really serious. So I took a big strategic decision to break a lot of the mortgages that I had until the middle of 2024, pay the repayment charges and refix them at the lowest rate in order to make now, was that a move to make money? No, not really. It was a move to manage risk and to peg a decent amount of the portfolio with 5 years worth of insurance at that lower fixed rate. It's a move now that looks like complete genius because rates went up so much. I'd rather it hadn't looked so clever because rates had only gone up a bit, but that's where we are. And so I also started selling some stock to re-gear the portfolio to say, right, okay, well, we are an acceptable loan to value, but depending on where you're at, 75%, carrying a 75% LTV portfolio, if interest rates go badly, as they kind of have, might not really be that viable, So I needed to just get some money out and put it back into the front end of the sausage machine, if you like. And because of all that time I spent on what I considered to be the hardest bit, which was finding deals, I then also realised that what I needed to be doing to continue to be more successful than just sitting there and waiting for property prices to go up, which of course you can do, and a lot of people do when they have property as a kind of side hustle strategy. But in order to be successful and get the extra returns, I needed to put more money into the front end. But to put more money into the front end safely, I needed to take it out of the back end and crystallize some historical gains and things like that. And also, when we'd gone to areas where, for example, 2016, I identified that the South Wales market was undervalued. There was the toll coming off the bridge between Bristol and Southeast Wales. There was, the Newport market was pretty buoyant and pretty cheap. And the price differential between Newport and Bristol was absolutely insane. And I knew that people would move. There would be geographical arbitrage, Now, when that played out, and then as it happened in 2020, 21, 22, Wales outgrew the rest of the UK in terms of its capital growth. Great. I didn't predict the pandemic. I didn't see any of that coming. But what that meant was, actually, do I now see a reason to hold that stock in Wales, or has it maybe outperformed where I thought it might get to? And it was certainly on the edge of outperformance, and thought, right, well, it might be a good time to sell a dozen of those or something, take profits, reinvest back in the front end of the funnel.
And I think that's a very sensible 360-degree view of your portfolio. Many people, you and I will know, talk about strategies, utilizing different strategies to buy, to hold, to develop property. Sometimes there is a very important element of a strategy, which is actually being efficient and utilizing that whole. It's not so much a cycle, but it's a process of property, because property needs to be bought and it needs to be sold. Just like money likes flow, property also likes flow. And you're right, there is a very important timing issue. What do they say? It's timing the markets, not time in the markets. It's important to time it properly so that you are exiting at the right time. But I'm sure you'd also agree, Adam, that there is also an element here about playing the government at their tax game, because tax, oh my goodness me, is a whole other issue when it comes to property, isn't it?
Well, there's been so many changes over even the time I've been in the game. So I was quite lucky in a way that I wanted to build the business to scale in the first place. And so I was using limited companies from nearly the first properties that I bought. I only did sort of half a dozen deals before I started using limited companies. At the time, I was told it was the wrong thing to do. You use limited companies maybe for flipping stuff, but you didn't use them for holding stuff, things like that. But I did my research and I was happy. And also there was such a limited sort of credit landscape out there at the time. I knew I needed commercial lending to really take this business to where it needed to be. And then I read a book, or perhaps it was just a case study, to be honest. I can't remember the name of the book, if it was a book, about Amazon and how they built their business and been very tax efficient about it. Now, these days, everybody thinks that means the intellectual property resides in Bermuda, so they don't pay any tax. Well, that's fine. But if you want to get the money from Bermuda, the net has been tightening over the years. And of course, tactically, all they did was wait for a Republican president to get elected and do a deal on the tax that they'd need to pay to reshore it back to the US. But so you can use wrappers within wrappers, but if you live in the US or the UK, the system, the net's going to get you at some point, and the IRS are pretty aggressive, as are HMRC, so that needs to be borne in mind. But what I mean by the tax structure they used was Amazon Group, by raising capital and raising the value of the business, but making a loss, because they were continually making a loss because they were expanding so quickly. So there needs to be property. It introduces a slightly different tilt on that, because if you are doing some refurbishment and some improvement to a property, HMRC have got some fairly woolly guidelines around what you can do. Does that go as capital expenditure on your balance sheet, or does that get written off against your P&L? And these are not decisions you or I would tend to make, Wendy, because we leave them to the accountants and the tax specialists, right? But it does enable you to build up a loss that's not a loss at all, because it's been used to actually bring the value of a property forward. And because it's brought the value forward, you can re-gear it and you can move the money out and move on. So I chopped and changed that Amazon strategy to try and use it in my own businesses to say, okay, well, if we haven't got, now we've paid an eye-watering amount in stamp duty, land tax, for example, and a huge amount in VAT, right? And we haven't necessarily been able to do anything about that. Generally speaking, we might stick with smaller contractors who aren't VAT registered, for example, but we've still got to pay the VAT on materials. So we've paid huge amounts of that stuff. But corporation tax, we've been able to be a bit more strategic, because by those accounting losses being in place, we've created tax shields. And the only problem, if you like, is that when you stop scaling the business, that's when this is exactly what happened to Amazon. 20 years of losses, and then suddenly, boom, they made $3 billion in one quarter. Now, we're not building Amazon, don't get me wrong, but you don't need to have a Goliath company to take advantage of the concepts that a lot of the biggest and best companies in the world have used.
I think that's really creative. I love that, Adam. I think that's you explained it incredibly well. And I think you're absolutely right that it's important that people don't just look ahead for the next 2 or 3 years, because often I'll meet people who are just starting, and so therefore they've got losses and losses and losses, and they're carrying forward losses, and they're not crystallizing a profit. There is no profit for maybe the first 4 or 5 years, but then they start to think, oh, I kind of want to live off the income. Oh, I want to sit here and just let the assets sweat. And that's great, because actually that's a wonderful place where you can get to, and you've got steady income from your property portfolio, and you're swanning around, going on cruises, and sailing around the world. But unfortunately then HMRC catches up with you. So I think it's very important that investing in property, it's what I call residual. It's not passive, because you have to actively still manage it, whether you are managing it from a point of view of the day-to-day running of it, or looking at it from a bigger operational framework in terms of the tax and the changes, as you say, that government has brought in, for example, with capital gains tax. That has been reduced 50% per year for the last couple of years. So your capital gains tax allowance has gone significantly down from what it used to be. If you hadn't thought ahead about that, you might get a very big shock now when you get your capital gains tax bill. Oh, yikes, how am I going to pay this? So I think there are things that you can do. There are the ways that you can use your knowledge very wisely to save yourself a huge amount of money. And actually, those savings can be extremely valuable when you're looking to continue to make your business efficient, and also to have extra money there to be able to invest when you find a deal that works. There's nothing worse than finding a handful of great deals and not having any money to invest with, whether that's your own or other people's.
Well, I think you framed that really nicely, and I think from the buyer's side of the fence, I bought properties, companies, portfolios, whatever, from people who I come at it from a different angle with the vendor. I'm there around the table saying, okay, well, look, there's 3 of us here in the deal, you, me, and HMRC. Do you care about what you've got in your pocket at the end, or do you care about what you sell it for, so you can tell your friends down the pub or wherever you want to boast about the exit price? Because I think we should be caring about what's in your pocket at the end, and we can do perfectly legally a whole number of things that are gonna help that. And people who don't listen to that, I have seen walk away from deals where they felt they've done a good deal, and then walk away maybe 30, 40, 50% less money than they should have, and then give themselves an inheritance tax problem because they've done no estate planning. And that's the biggest mistake anybody can make, because what's been the point of doing all that work? You're in a situation where potentially, if you sign the papers, do the deal, cross the road to the pub to celebrate and get run over, HMRC is going to have taken 86% of everything you've ever created or whatever. And it beggars belief. I think people they have to understand the difference between delegating responsibility and absolving themselves of all responsibility on the financial and the tax front, because there's a huge difference between those two things. But by understanding this stuff, it can also allow you to create opportunities or craft deals that are more palatable for vendors, and also see them walk away with more money from deals. It just means you're going to have to hold this for a number of years, or perhaps when you dispose of it, you realize you're going to have to dispose of it into a tax efficient vehicle such as a pension or some kind of similar institution that's going to have a tax break, because that will make those problems go away. So this, your point about not, trying to think more than 2 or 3 years in advance is a very, very good one. And people need to absolutely think multi-year. You shouldn't be getting into property if you aren't thinking 10 years in the future,
Totally.
even if it's not your 10 years, but your company's 10 years in the future. So yeah, absolutely agree with that.
Yeah, totally. I'd like to talk a bit about macro, though. I'd like to move on, because you are so good at this, Adam. You do think about the bigger picture. You do think about what's going on in the world economy and in the UK economy, and how it affects housing, and not just economic factors, but other factors such as the market. And I mean the market of people, the market for tenants, as well as money markets. So what do you see happening at the moment? What concerns you and what excites you?
Brilliant. Well, firstly, can I say flattery will get you everywhere, Wendy? But I think you have a lovely way with words that frames the questions and the problems really, really nicely as well. So you're making my job a lot easier for me. But I think what surprises me, if I remember back to when I worked inside one of the UK's top 10 lenders, as you said earlier, there was a position in that company called business architect. And I thought, that sounds cool. What does this person do? And the answer was, it was their job to understand everything that was going on within the business and know that if you change that little lever over here, that over here there might be an unintended consequence, right? And try to understand that and see those problems coming before they started. And I heard that and I thought, wow, someone with a real understanding of strategy has put that person in that post. And the person who did that job was actually very suited to it and was very, very good at the strategic thinking side of things. And it was probably, I remember just thinking, I'd love that job. That job just sounds like so much fun. And the problem that we have at sort of public sector level is we don't have that business architecture at all. And in fact, we don't even have it intersectoral. So we don't even have that in housing, because we'll change one thing or we'll do one thing to make the Home Office figures look better, and it'll have a massive knock-on effect to the local authority budgets, which isn't helpful to you or I as the taxpayer. It's just spreadsheets and meaningless headlines. So if you don't understand, for example, the net migration side of things, and in terms of your specialist subject and HMOs, what the opportunity that presents, and the dearth of housing that there is, and the fact that people have actually been coming out of HMO on a net basis over the past couple of years. We don't really have any real-time figures. I'd suspect that might have reversed now, but maybe not, because, interest rates are still high and it's difficult for investors. So from all the data that I've seen that's out there, which is not very much that's provided by anyone with credibility, HMO has been declining. And then you just think, well, hold on, you've had these incredible pressures in terms of energy prices going up and people then going, how do I contract out of worrying about the gas bill? Go and live in an HMO. Great idea, right? And that's just one little factor that's made a difference. And then average household that comes into the country as a migrant is 1.25 people strong, aka most people are coming in on their own to work. They're of working age, and they're economically looking for a better time. They might then, in years' time, move family over and things like that. Now, obviously, also understanding a bit about policy, the Home Office have clamped down on a bit of that, mostly for political reasons, although there have been changes to the mix of migration in the last few years that they felt they needed to act upon. So that's just looking at migration, whereas people tend to look at, there's a big deal at the moment with the Bank of England and the Resolution Foundation and people like that who are saying, well, stocks only dropped by a relatively small number since 2019. And that sort of stuff drives me mad, Wendy, because I just think, well, what's the context of the population, the rental population growth since 2019? Well, it's probably a couple of million people, right? Yes. And we've got 10 years ahead of us where that rental population is going to grow further just because of our organic demographics, right? Now, 25 years' time, it might look a bit different, but we need to understand what migration might look like at that time as well. But if we just limit ourselves to 10 years in the future for the moment, we can see there's a huge runway for providing, supply of tenants is not going to be an issue. Supply of properties will be what the issue is. Tenant demand will be huge. And the need and the want to, and regardless of what anybody says, once you've applied inflation to a lot of these figures, and once you look at rents over the past 25 years, rents are actually still comparatively cheap at the moment as a percentage of people's disposable income. Then on the flip side of that, you've got the fact that disposable incomes have been forced up by inflation. Wages have lagged other price growth, so people are still catching up from the cost of living crisis. But also this government's taken a really strong position to push the minimum wage really far forward. They're really in the mixer now with how far they're pushing the minimum wage. And then you understand how that impacts potentially on unemployment, local housing allowance, which is a bit outdated, but still the system of choice these days, even within the universal credit system. And you can very quickly see how many bits I've tried to put together there to get a broader brush picture of the sector. But the ultimate message is, rents are going to be rising probably in HMO faster than in single let. But I'd be stunned if we didn't see another 25% increase over the next 5 years. You'd have to be regionally aware of that, because I'm not necessarily talking, PCL zone 1 or whatever, but I'm talking about provincials in general. You need to look at your own areas or decide you're going to other areas. How do you do that? Well, start with population growth forecasts. That's a great way to look at it, because Bristol still looks very, very bullish in terms of how many more people are being attracted to Bristol on an annual basis, whereas there might be some places in the northeast where that's not so good, or Aberdeen would be the opposite example, because there's been no investment in the oil and gas industry. Regardless of the oil price, people have been moving out of Aberdeen for some time, and there hasn't been a real plan to attract people to Aberdeen for other reasons. And then, of course, the rest of the country lives somewhere in the middle of all of that. Work out where you are, why you're there. This is what funds do, obviously at a much more complex level, buying market intelligence and stuff like that. I'm just trying to do what one person can do and boil it down and share what I find out with anybody who wants to listen, really, Wendy, I guess.
Well, I think it's fascinating, because if we really crystallize what property does, what's the purpose of property? It's to give shelter. Maslow's hierarchy of needs, it's one of the basic needs, isn't it? That food, water, shelter, this is a basic need that, particularly in our climate, which, personally, I'd like a bit of global warming, particularly today. But in our climate, we it's not so easy for us to go and live on a beach, or live in a cave, or live somewhere under the trees. In Great Britain, the United Kingdom, we need to have really bricks and mortar. That's the best shelter that we can have as human beings living here, and trying to be productive and contribute to society, and so on and so forth. And therefore, this need that we have for shelter is never going to go away. In this neck of the woods, we're always going to need it. So it's a basic human provision. It's a basic human need. And as you say, if we then look at what humans are doing in this neck of the woods, they're coming here in their droves. We're obviously seeing, there's political devices happening around trying to restrict immigration. At the moment, obviously, illegal immigration, but actually legal immigration is a far, far bigger number than illegal immigration is. And of course, these migrants who come to the UK, they often are contributing massively to the economy. In fact, they have to really have the opportunity to come here, unless they're studying here. And even then, they may well choose to stay in the UK and get graduate jobs and so on, and contribute to the economy. But as you say, that just looking at those figures, looking at those statistics, should surely indicate the demand and the needs. Then, of course, we have the other very simple element, which is supply side. What's the supply doing? Well, if the government had been building their 250,000 units of accommodation over the last 10 years, we perhaps wouldn't have such a big gap between supply and demand. But we've got a massive gap, because we've got all this demand and we just don't have the supply. Now, that is only one element, of course, that pushes up housing prices and housing costs. The supply demand kind of factor is one of those, but it's not the only one. But I think even that at a very, very basic level is key. And one of the other things that I sometimes talk to people about is even within those demographic numbers, you can see niches. And many of us who are investing in property may just have a handful of HMOs. You don't have to have 100,000 HMOs to do very well out of them. Just a handful of HMOs can change your personal lifestyle. It did for me when I had about 4 or 5 HMOs, and they were making enough money for me to give up my job. Now, that's a great position to get to, because then you free up your time. And, time is the most valuable resource you have. It is worth endless amounts of money. So having your time is absolutely critical. But what I often say to people is, you don't have to have an empire to make a difference. And you don't have to have an empire to make a difference to your life. But what you can do is you can create a very, very valuable business by servicing a niche. And if we look at UK demographics in terms of the aging population, Adam, and this is another area which I think, again, gets very little focus from politicians. They occasionally will refer to it in passing. But actually, although we've got a lot of working age people coming into the country, those of us who perhaps been born and bred here, we are getting older. There's more of us oldies around than there are of the younger ones. Numbers of the birth rates are falling, although actually, again, this could well be rebalanced by immigration, which is a really good thing. But natural sort of British-born births are falling, and therefore we're going to have this aging population who very often don't want to live on their own. They want to live in a shared form of kind of accommodation, and we've certainly had more and more tenants apply who are either semi-retired or retired, which 10 years ago was almost unknown. And yet now, on a regular basis, I would say 1 in every 30 to 50 tenants we have is what I would call an older person. Now, imagine that on 10 times. And as you say, in 10 years' time, let's say the 48, 49, 50-year-olds, as are today, they're going to be heading for 60. Some of them are going to be going through a particularly difficult economic headwind over the next decade, I believe, because of various factors that are at work. And they may find themselves looking for accommodation in an HMO. Well, that means that there's going to be an opportunity for people. We've had young professional HMOs, we've had student HMOs, we've had supported living, supported housing HMOs. What about now older people HMOs? People who are not particularly vulnerable, but they may be retired, and they, a bit like, in American communities, you see these retirement villages, don't you, where there's people doing all sorts of activities, and they're very fit and well. These are not decrepit old people. They don't have Alzheimer's. They're not falling apart. They don't need care, but they do need something to do with their time. Could UK HMOs go in that kind of direction? I don't know. I think it's a really interesting point to ponder.
Yeah, I completely agree with you. And you see, you just went into last year's. I mean, I've got a couple of businesses that are involved in the care sector side of things, and the numbers are equally, if not more, compelling than the overall private rental sector, Wendy, because 500 and odd care homes closed last year because the regulation has kind of tightened around the neck of smaller homes, even though in the rest of everything that the public sector does, they prefer smaller, more intimate homes. But these days, private equity or whoever won't look at a home that's smaller than 80 beds for a build. And in the ideal world, they'd love a 400-bed retirement village. But in a way, that might work because there might be some common facilities that can be shared in the same way there is in a build-to-rent block of a certain scale. So that shouldn't necessarily be thrown out. But it's not the nice, quiet, social, which obviously an HMO, when you get the matchmaking side of things right with your tenants, can provide so many positive things for people, because it can provide people with similar interests, people who've got a similar amount of time on their hands, people who want a bit of companionship. We've got many, many more people in society who aren't coupled up anymore, many more who aren't married, but many more who are sort of habitually single these days as well. So it's a very different dynamic from what we would have seen 20, 30 years ago, like you say. And what we've also got at the moment to supplant that is you're talking about, you know, the baby boomer generation and the end of the baby boomer generation, which has had much more of an economic advantage because, apart from anything else, things were put into play. When we started the pension, you know, people were supposed to live till they're 67. A lot of these have lived into their 80s. And so there's a huge mismatch in terms of the public's finances. Now, nobody wants to take that on because nobody wants to be politically never elected again for trying to sort that out. But that is a fact of life. Will we go to the stage where people are then going to live on to 95 and beyond and still draw their pension? There's two schools of thought about that at the moment. One feels we might have gone as far as we can, but we'll soon see what drugs are developed for Alzheimer's and dementia and things that are already being developed around obesity and other things that are happening at the moment in society might change that one way or another. So might banning smoking for generations or whatever. But my point is 10, 20 years down the line, we're going to access a generation that maybe isn't as well off as the current crop, which quite regularly would rather buy a brand new McCarthy and Stone or whatever retirement pad and can afford £2,500 a month service charges without too much of a problem. Well, people aren't necessarily in that boat in 10 or 20 years' time because things have changed a little bit. So we'll see what happens. But, you know, there's an economical perspective, and, you know, co-living when it's done well can be fantastically positive for people. So I could certainly see if my life had gone in different directions at different times, I could have been quite happy in an HMO, a variety. I mean, I did it when I was a student and it was great, you know. So, but there's other times of life where it can be really positive as well.
Now, one of the things that does bother me, Adam, is government debt. Should I be worried about the levels of UK government debt?
So I had a lovely email a few weeks ago from someone who follows what I do and said, look, I've written this, it's quite basic, but it might be worth you having a look at it. And it was kind of the government portrayed as a household. And we always hear the government is not a household. And there are reasons for that. But there also, the concept of being fiscally responsible, I think, is one that everybody should try and embrace, regardless of any political affiliation. So the reality is, if we thought about it the way we might think about a company of ours, Wendy, from a balance sheet perspective, we don't have a lot in terms of assets anymore because a lot has been sold off. There are arguments that the UK has got negative assets at the moment in terms of, you know, physical assets they might have versus liabilities, businesses to sell off. So then we might look at income and look at serviceability. If you or I wanted a mortgage, we'd expect it to have at least 125% of the debt as our serviceability. Well, we don't have that in terms of our tax revenue by any stretch of the imagination. Our tax revenue is about 85 to 90% of our serviceability. And of course, the massive increase in interest rates has caused us a problem because, like a lot of things, the UK government's currently surviving on average. The debt is a lot lower than the debt that they're having to issue today because they've issued so much long-term debt. So not many assets, not a great surplus. Well, in fact, a deficit in terms of all of that. So what keeps things going? Well, belief, really. I mean, the concept of someone like the Green Party would say we need to stop growth. We would have a major league problem because we'd have to default on our bond debt apart from anything else. Or where could we go if we had to? And this would depend on who's in charge of the country. But where are the true assets left in the UK? Well, in the households and the businesses, right? We've got 10.5 trillions worth of residential property and we owe just over 1.5 trillion against it. That's an incredible reserve that we've got. Now, don't tell the government we've got that because they might try and tax it and get it over to them. And this is where you then start to get into an authoritarian versus libertarian argument and what size should the government be? And really, wherever you sit on that spectrum, to again try and keep it apolitical, I think what we should all want is best value for government pounds. But what we should also want is, coming back to the conversation we were having earlier, a longer term strategic viewpoint, not we're desperate to balance the books over the next 3 months. So we've got to stop all benefits because that'll solve the problem overnight. It's like, well, it really won't, because the knock-on effect of that will be jails, will be longer term scars on all sorts of things. A bit like what the pandemic has done by stopping schooling I was saying at the time, the fallout of this is going to be really, really considerable, and it's going to cost society far, far more. Now, of course, it's a difficult discussion to have when you're talking about people's lives, but economics isn't known for its compassion, Wendy, at the end of the day. It's there for brutal reality. So are you right? The good news, I guess, is that everybody still believes the scam and there's no major issues there. It's a good job I'm not on the Bank of England Monetary Policy Committee, isn't it? But in reality, if they needed it, they have got assets they could co-op. I mean, who owns the government? I mean, really, the households do, don't they? So we own that debt. So from a group, if you thought of us as a group of companies and the government was here and the households were over here, we sub them who are behind. And we've got tons and tons of money behind us. And the businesses were maybe, the corporate sector was the third group in that group of companies. The businesses have got tons and tons of money. They're in great shape. They throw off money all the time. So we haven't got a major league problem, I don't think, around any of that, but only because people believe that the system works. The interesting thing about the whole Liz Truss thing is what happened with Liz Truss and Kwasi Kwarteng really was them saying two fingers up to the system. We think the system's a load of rubbish. But what they did inadvertently and not realising it is they basically sent the message out saying, we're not going to be accountable to anybody. We're not going to listen to the bodies that have been put in place to provide checks and balances. And if you do that, they obviously never dealt with investors in their life before, because if you introduce massive uncertainty, the investor just go, well, we don't want any of this. Thank you very much. We'll just stay on the sidelines. We'll sell all our positions. We're not going to lend you any more money. And of course, the whole system is predicated on people lending us money because we're constantly in debt that revolves. Now, the other reason why maybe you shouldn't be too worried is the greatest secret the devil ever pulled is convincing the world it didn't exist, is that inflation is their answer to a lot of this. Now, if we go back to the last time we pumped the economy full of debt, post WW2, we had genuine economic growth that took us forward. We also had uncontrollable inflation at some points over those years, particularly in the 1970s, but we had very high interest rates and at points higher inflation in the 60s as well, So inflation, we can't fixate on we now owe 2.5 trillion. In 2010 we owed 800 billion. Okay, that's bad, and that's obviously more than inflation since then. But if we put together, number one, a repair package for a probably 1 in 75 year event in financial markets, which did have, as you said earlier, a lot of regulation. There was a lot of activity there, which has repaired a lot of those problems and stopped those bubbles from forming again. Then we had a 1 in 100 year pandemic. Right now, again, there's work that now says perhaps that 1 in 100 years, there'll be another 1 in 25 or 50 years. We don't know. But we've had those two events within 12 years of each other. And so there would be expected to be a repair phase, but nobody wants the Prime Minister or any political advocate to stand up and say, the thing is, guys, we need about 40 years to recover from that pandemic. Is that okay? Because nobody wants to hear that, because we're all thinking, hold on a second, in 40 years, I'm retired or dead. I'm not having any of that. I want the future people to pay for it, whether they admit that or not. That's what's gone on. And I think successive governments have been weak about not zooming out and taking a longer term view. But in a way, you could just blame the system for that, because the political cycle has forced us into 4 and 5 year rotations. So is it a surprise that our energy policy, which we need a 40 or 50 year view to fix where we are, to get to net zero and all the rest of it, the only reason we're doing it is because our back's so far against the wall, and now there's political will to put masses of money into renewables, even if those renewables might well mean that the poorest 10 or 20% of society suffer the very most, because their energy consumption isn't necessarily loads less compared to their income is so much less than people who are in the top 10 or 20%.
And I think actually that's where I feel taxed, and that's perhaps not quite the right word, but I feel bothered by it, because personally I feel that it's the poor in society who suffer. Yes, it's very easy for governments to say, well, we'll inflate our way out of the problem, and that is always seems to be the answer. We live in a fiat economy, so it's based on trust. It's based on this bit of paper with a man's head on. We trust that it is the value of £10 or £20 or whatever is on there, but it is only a bit of paper. And this originally was had some backing to it. Well, we don't even have all that gold anymore. That's gone. Although if you look at the gold price recently, you'll see that gold has been doing very, very well. There are certain people very bullish about gold at the moment, for various different reasons, political as well as economic. But I think that what bothers me is that the poor in society suffer when inflation takes hold. And when you have inflation of 5 or 6% per annum for 2 or 3 years, the problem is you have a compound effect. Even if it returns down to levels of 1 or 2, it's still 1 or 2 on the backs of 5 and 6 for 2 years. So if you think about the compound effect over 3 years, you could be paying 10, 12% more for basic goods and services than you were 3 years before. And you're right that the government has raised the living wage, national living wage levels quite significantly. But one of the problems with that, of course, is it actually forces a lot more people into unemployment because they are not employable at £11.50 an hour or £11.40 an hour. They're only worth to a company £9.50, but nobody can pay them £9.50 because they're not allowed to anymore. So I personally feel that the constraints on the system to have a really freer market are forcing more people into unemployment. Of course, from the HMO market, that's actually really good because it means we've got more people who need housing. The government have a duty to house those people. Well, local authorities have a duty to house them. And so, if we can buy property and, just make a couple of phone calls, very often you can fill your HMO. But I do still feel an ethical, in your introduction, I mentioned, Adam, this is one of your core values, is to do things ethically. And for me, I think as property investors, we can't ignore the fact that inflation may well be great for us. It denudes the value of our debt. It means that our assets are growing in value, okay, relative to the value of the currency, but nevertheless, certainly it reduces the value of our debt. And it's great if you have assets, but if you haven't got assets, and if you're reliant on an economy and you're swapping your time for money, you're the one who's going to long term not be in a good position, and that does bother me.
Yeah, I completely agree. And I think, interestingly, in all of that great stuff you've just said, you state the idea that raising the minimum wage so aggressively would force people into unemployment as fact. And I completely agree with you. I think it is fact. And the reason why you can tell that it's fact is if the minimum wage was 100 quid an hour, we know that nearly everybody would lose their job. So we just come back from the brink to evidence that. It's not a linear relationship. But some people politically would disagree strongly with both of us there and say, well, no, minimum wage should be forced up. The company should pay more. Where's the government, I think, has looked at it from the point of view of let's move these people because we've got so many people, more people than ever, who are in work but on benefits. Try and push that wage up because it'll take more people away from what they'll need to pay for in terms of top-ups. But actually, working and receiving benefit is better for the government, therefore better for the taxpayer, therefore better for everybody else, than not working at all and in receipt of significant benefits. And then there are cascade effects to not working in terms of mental health and all these other things that there's plenty of bodies of evidence for. So I completely agree with you. The solution is not just to keep jacking up minimum wage. You have to listen to what companies are telling you. And you also have to be quite careful. It was probably a bit of a surprise when the Conservatives introduced the sugar tax to drinks. But for once, they actually stood up against big food and said, no, we don't agree this is going to cause a big problem because you guys are either going to have to sell your drinks at a higher price or change your formula. And everybody apart from Coca-Cola changed their formula. And Coca-Cola didn't because they were so paranoid, because when they changed their formula in the 80s, Pepsi almost outsold them and it nearly ruined the company that had already been going 150 years or whatever. So I think you've got to apply the same sort of logic in a way to picking your battles, not just coming in with this kind of, right, we must put minimum wage up and that will solve problems. It's back to that social architect kind of role to say, well, are you sure about that? Because we can't go past this point. We can't keep going to the well. And I think, you say about inflation, most people don't realise 2010 to 2019, the average rate of inflation in the UK was 2.7%. So it was still well above the target for that decade, even though there weren't any major inflationary moments. There was a bit in 2011, there was a little bit after the referendum, but really, it just shows you the government see the only weapon they've got is inflation. And the real danger, back to your initial point of concern that kicked this conversation off, the real danger is that we don't have the right sort of inflation. So post-World War II, real growth, rebuilding, loads more opportunities, efficiencies being created all over the place. People often laugh at the proliferation of the washing machine was one of the most incredible things for the labour force ever, because it nearly doubled the labour force overnight, because you went from washing being a 3, 4, 5, 6 hour activity to you could put it in a machine. Now, it didn't happen overnight because not everybody bought or could afford a washing machine overnight, but over the course of generations, it's made a massive difference. And some of the concerns can be, AI perhaps has a role in this or not. I think the fears, aside from the sort of Terminator Skynet fears that some people have, the fears that really a small handful of really smart people will know how to harness it, and that will make a lot of people worse off. And back to your point about the tax system, we all know it was introduced for the rich in the 1300s or whatever, and then it crept into the upper middle class and then the middle, and now it's the poor that not only really pay the most in percentage terms, but also when inflation comes along, there was all these studies, weren't there, of the lowest price stuff in supermarkets, the value ranges or whatever, they were up the most in percentage terms because the cost of delivery, that last mile fulfillment problem that the supermarkets had. So the poorest in society were facing maybe a 20% inflation rate at certain points over the past few years. So there's a massive need for fixing of this problem. And we're not fit, but we've got a whole system that's built around, like the NHS is built around, sort of sweeping up the problems, not addressing the root cause. And I'm not deriding the NHS in any way. The problem probably starts at the top level of government, where we have mechanisms now to tax tech companies on turnover because they're so good at legally avoiding tax, but we don't apply those mechanisms because lobbying kicks in. And we want a nice job afterwards when we've left our post, that whatever. So we don't do what we really need to do for societal good. And that the problem with doing what's needed for societal good is that probably means, well, it definitely means NHS reform, pension system reform. And I'll probably stop there, because no one would ever elect me or anyone with my ideas ever in that department, because they'd be voting, it's turkeys voting for Christmas.
Well, you're absolutely right, Adam, and we could discuss that all day. I think it's very interesting. And of course, this is where you start investing in a single buy-to-let, and this is where it ends up. You're becoming a political commentator. Who knew? So before we finish, I'd like to get your views on, let's say, the next 12 months. What do you see happening? What do you think are going to be some of the key, perhaps deadlines or areas of economic and historic situations that we should be keeping an eye out on as property investors?
So I love that one, because we've got some interesting things that are going to, what do we know? What have we got guaranteed to happen over the next 12? Election, that's obviously a big part. Where are we at the when that happens historically, when the election is called, things tend to calm down in the market. People don't like uncertainty. House is the biggest investment most people will ever make, so they defer that investment decision until after the election. What does that mean for us? Maybe there's a purple patch for acquisition there, because suddenly if a lot of buyers drop out of the market, it might well be worth considering what you're going to do. And the fear of a Labour government will put off way, way, way more people than the actual Labour government when it's elected, in my view. And this has happened, over and over again when there's been, we've got a bit of election lag these days because we have had so many elections relatively close together. But of course, we've been nearly 5 years now since the last one. So that's a guarantee. Then
And
you've
it
got to
might be
throw
also,
the
just to interject there, you're absolutely right that the general election is a key one, because on the run up to the general election, both parties will be vying for the electoral support. So there's going to be a bit of carrot and also stick, and it's going to be when do these pieces of electioneering come out into the public awareness. And for some landlords, they're going to be saying, oh, that's it, I'm going to throw in the towel, I've had enough now, I'm selling and I'm happy to take what I can get. For others, they're going to be wanting to adopt the Warren Buffett be greedy when others are fearful message and actually start to accumulate more. So I think you're absolutely right. I think there's going to be deals worth having, and I think possibly also people are going to be a bit more open to possibly doing more creative deals such as lease options and so on, because they're going to want to potentially sort of hedge their bets a little bit as well.
Yeah, and things
Sorry, I
like vendor
interrupted you.
that's all right. That's right. Vendor finance, exchange with delayed completion, they all come into the mixer there. Absolutely, if people want to crystallise their positions, which might make sense. I mean, not many people will be thinking, oh, Labour will come in and they'll lower capital gains tax. Jeremy Hunt's given a little bit of a bone to the landlords who the Conservatives have slapped around really for the last 9 years or so and said, well, at least CGT's come down a bit. And now you've got no allowance. You might as well sell now, which is incredible, really, reading in the budget summary the kind of behaviour is trying to encourage. But then you've got to have, you've got to tip the hat towards the geopolitical situation. There's, looking at again from a data-driven perspective, about 75% of the world's population are exposed to negative geopolitical events at the moment, according to the strategic defence commentators. The normal number is more like about 50%. We're just lucky we've tended to live in the 50% of the world that hasn't felt that for the last, 60, 70 years, although we have gone out and got involved in some conflicts ourselves, obviously. It hasn't really had, real negative implications for the UK. But where you see, we're talking about Russia going into Poland or whatever, I mean, this is serious because this is NATO and this is Article 5 and all the rest of it. So what that would perversely do is increase GDP because the defence spending would have to come from somewhere. And going back to your concerns over the UK solvency, let's say, international investors normally open up in those situations and say, look, we know you need long-term money. It's going to be an awkward time. We don't mind providing those longer dated bonds and stuff that you're going to need in order to arm yourself properly to get involved in these things. So that's a bit of a concern. What does that do for overall investment? Well, it depends what actively is going on, because it's obviously pushed investment out of, obvious thing to say, but it's pushed investment out of Eastern Europe, and started to push it further west as an emerging market. The more of a problem that comes, the more it pushes that away from there. Who's investing in what at the moment? Well, liquefied natural gas looks to have, more time to run and all the rest of it. So that needs to be considered. But in terms of, we know where we are with supply and demand, as we talked about earlier. The problem, the one blocker at the moment is still going to be that interest rate, because we need that price to start coming down steadily. Whereas really what we saw is huge spike upwards with trusts, big spike back downwards where it found a bottom, even bigger spike upwards in the summer last year when the market was going, oh no, how high are these rates going to go? I think we found our top, but we're struggling to move down Table Mountain with the bond yields. And we've had, the perversity of the fact that you get positive economic news, which means negative things for the bond yields because it pushes the yields upwards and debt gets more expensive. I'm expecting us to go sideways and a little bit downwards this year. That's consistent with my predictions throughout the whole of the year. I haven't seen the need to change that yet. I actually think we're a little bit high at the moment, but politically and reputationally, there's a bit of pressure on the big banks not to push the rates too high. And I'm sure the government incumbents are leaning on their friends in the big banks and saying, look, you better not put the rates up a lot here. I don't care if you've got to take a lower margin. We need to win an election, mate, or at least make the best fist of it that we can. So I think that period before the election, I'll concentrate on quite heavily. I wouldn't be sitting on the sidelines waiting for rates to get a lot cheaper. I think things need to stack at today's prices. And as you said, you're looking at all the tools in the toolkit for creative deals at the moment. People can exchange or, substantial performance is the HMRC term, but substantially complete a contract, and then the stamp duty can be due, and then Also, from a capital gains perspective, the price has been enshrined and the tax rate has been enshrined,
Yes.
regardless of whether they get the money over the next 10 years or whatever runoff period you might have to negotiate. So people can guarantee price and tax rate by transacting pre-election, and they won't be able to guarantee any of that post-election.
Yeah, very good point, Adam. Very good. So I think to sum up, you're still as positive as ever about property. I think you know from speaking to you today, you know, I can see you're still as determined as ever to continue to grow your own portfolio and to help others to do that in a wise and considered way. And you know, I think it's great because, like you know, I've been through a long enough time investing in property to know it like any business, it has highs and lows, it has ups and downs, it has troughs and peaks. But actually, as you said earlier, I think it's very, very valuable. You have to be in it for the long term to make this work, because it's only by sitting and keeping going, whether that's trading, developing, adding value, holding, that you actually see those gains in the long run. And you know, so anyone who's listening to this and thinking, oh, you know, should I get out now? Should I sell up now? I think from what Adam said, and I would very much agree with that point of view, no, don't. The key is cash flow. Cash flow is king. I think Hilary Devey once said that cash flow is king. And if you can ensure that your cash flow is sound, then basically the world's your oyster.
Very good. Very good.
Well, listen, Adam, it's been absolutely fantastic to have you on today. Thank you so much for being here. I've really, really enjoyed interviewing you. It's been so good. And I literally could spend another 2 hours talking to you about those different elements of macro and property. But thank you so much for your wise words today. I know it will give people very much food for thought. And obviously, we wish you all the very best for the rest of 2024 as well.
Thank you very much for having me, Wendy. It's been my pleasure. And thank you for your insightful questions.
You're welcome. Thank you for listening to the HMO Success podcast. If you'd like to know more about how you can create a profitable HMO business, please visit our website, hmosuccess.co.uk, to find out more. We have plenty of free tools and information for you there, and also on our Facebook group, The Ultimate HMO Success System. We look forward to connecting with you very soon. Thanks for listening.